Good afternoon, everyone. My name's Helen McIntosh, and I'm the President of the South East London Chamber of Commerce. Welcome to today's webinar, and we're going to be hearing from Hornblower Business Brokers and Thackeray Williams on really how do I sell my business, what businesses sell. We're going to learn a lot today. I'd like to hand over to Henry Campbell-Jones, who's the Managing Director of Hornblower. Over to you, Henry.
Thank you, Helen. That's sorted, isn't it? And for your introduction and for having me to speak today. Firstly, a quick introduction to Hornblower. We are a business brokerage. We specialise in selling businesses in the SME market. We work with businesses that turn over typically between 1 million and 10 million. We have a particular focus on engineering businesses and manufacturing businesses, as well as service sector companies like IT support and managed services and software as a service businesses. We also look at other traditional style businesses in the facilities management sector and commercial cleaning and various other service sector, but it tends to be B2B. We have offices in Bristol, London, Nottingham and Dublin, and we service clients across the UK and internationally. And really we look to work with business owners that are looking to retire, having set up their business maybe sort of 10, 20, 30 years ago, or who have got to a certain stage in their business cycle where they need more resource and management resource to grow to that next level. And that's where either an investor type of buyer or a trade buyer will come in. We offer very sort of hands-on service, and we like to sort of work with fewer clients to get a better success rate, which is proved by our selling sort of 80% of the businesses that we retain for sale within 12 months. So I thought the title of the seminar is when is the right time to retire? Is now the right time to retire? So I thought I'd address that question by looking at sort of which businesses sell well and why, and also look at which businesses don't sell well and why. And perhaps by going through that, you can get an idea, relating that to how your business operates, whether you are ready to sell and whether now would be the right time to sell. So I'll just go through which businesses sell well and what are the key traits of highly sellable businesses. If you're in the service sector in particular, and I'm going to take an example of an IT support help desk type of business, it's a competitive sector. And because of the business model, it's quite difficult to grow organically. So if you're a service sector, if you have secure contracted revenue for a service that you deliver month on month for a certain number of users, for example, that brings in recurring revenue, then that is something that is very attractive to buyers, particularly in the service sector, and is something that's makes the difference between getting a good offer on the table with a good amount up front and getting a deal that's much more structured. Also something to look at is, are there any synergy saving opportunities for a trade or strategic buyer? So that's a buyer that's maybe is in a similar sector to you and is able to bring sort of back office support, sales support, finance support to take your business to the next level. Now, next one is supplying to a niche market. Now, if you're a company that doesn't have regular service contracts, which, as I said, so bring in recurring revenue, something you need to look at is how to protect sort of good margins in your business, and to protect against new entrants, and that's really what buyers will be interested in. And if you're supplying into a niche market, or if you have a niche product that is difficult for a competitor to come in and and emulate in your marketplace, well, that puts you in a very good place for a sale. Market sector, and looking at whether your market is set for growth. Now, at the moment, there are a few good examples of that. There is, again, IT managed services with the move to remote or hybrid and office working, a hybrid office working environments. There's a lot of demand for technology services. And I think that's set to continue even as we come back to work. There are some areas of the construction sector which is seeing a bit of a boom at the moment, and particularly with the change around possibly in office space, companies moving office, whether upsizing, downsizing, but due to the changes in the models of working, that is actually leading to some good demand for those in the office and shop fit out sort of space, as an example. So if you're in a good sector that's set for growth, then that's something to look at in terms of which businesses sell well. Now it comes down to how your business is organized. Do you have business processes written out? Do you have a manual for your employees and your management team? How does the business fare if you go on holiday, say for 2 or 3 weeks? Are you on the phone a lot of the time, or answering emails whilst you're away, or how does the business function without you? Obviously, this will depend. The next point in terms of having a strong, what we call tier 2 management team in place, will depend on the size of your business and the scale. But if you do have some key people in your business who can take the reins on a day-to-day business basis, so that you are more in a leadership role, giving, thinking about strategy and giving sort of high-level guidance to the team, then that is something that will make your business sell better than if that management team isn't so much in place. Obviously, next point is looking at the growth profile. Are you growing year on year, or is there a bit of a cyclical nature to your revenues and profits over the last sort of 2 to 3 years? That will have an impact on the buyer's confidence of the business going forward. And then we can look at some good customer spread. What I mean by that is how reliant are you on your top customer? We come across some businesses, particularly possibly in the engineering sector, where the top 2 or 3 customers represents maybe 40–50% of revenue. And what that means for a buyer is that it's a bit of a risk should that top customer decide, for whatever reason in the marketplace, that they need to go and use a different supplier once the deal has been done. So as a rule of thumb, we always sort of recommend that your top customer needs to represent a maximum of about 15%. And lastly, in terms of which businesses sell well and the approach to selling businesses, obviously be ambitious in terms of the valuation that you'd like to achieve, and we will go out and get the best value and deal structure that we can in the marketplace. But you need to we work with prospective sellers to get a realistic valuation and understanding of that valuation in the marketplace, because if you want to sell the business, we need to start from a good sort of expectation point with the marketplace. Now let's touch on why businesses haven't sold so well. And again, it comes down to, in our experience, the reliance on a top customer, or dependence on one key supplier, or a distribution agreement with one key supplier, and not having the flexibility to be able to source product or service elsewhere. You can look at the economic cycle, and really this will depend on the sector you're in. But say if you're in the events sector, then your economic cycle and the business cycle probably isn't in such a good space at the moment, or hasn't been over the last 18 months with the lockdowns, as it was pre-lockdown, and hopefully as it will be in a year, 6 months, a year or so's time, once we're all back and sort of events are going ahead again. So that's something to look at. But I put owner's personal cycle there as a reason, in that it's always good to sell a business when the business is doing well and you're enjoying it. And it might be counterintuitive, selling at that moment in time, but too often we see prospective sellers who have passed that moment and have maybe got a little tired of the business, and it's not running as sales start to, I guess, drop off a bit, and the energy within the business and the organization, organization structures aren't quite as good as they were a few years ago. So it's something to bear in mind, is not to go on too long. Another thing that can block a sale is to what extent the client relationships and operations are dependent on the owners themselves, and that is something really to try and address and think about before putting your business on the market. Management accounts and financial figures are also key to being able to have a discussion on valuation. Buyers will need to have the latest figures to hand. So if we're relying on your latest year-end accounts, which were for your year-end, which was maybe take for an example now the end of December 2020, buyers will need to know how business has gone this year, and therefore we do need to be able to present monthly management accounts to show the latest sort of revenues and profit levels for the year. Okay, that's a little bit about which businesses sell well and which have not sold so well, and the reasons. I thought I'd just touch in the last couple of minutes on valuation and how businesses are valued. So there are various techniques to valuing a business. They're normally based around a return on investment, and therefore that comes back to a multiple of earnings. Typically, we use earnings before interest, tax, depreciation, and amortization. So you've probably heard of the phrase EBITDA. That's what that stands for. But we also look at the net assets in the business and the cash that's available and in the company, and the amount of borrowing that's in the company as well. And that will have an impact on the deal structure and the overall value that can be achieved. So some of the inputs there that are up on the screen are some of the points that I've made in terms of which businesses sell well and which don't. So I'll move on to some multiples, which will hopefully give you an idea of how businesses are valued. So it will depend to a large extent on the size of your company, and very roughly on the slide here, I put some multiples of EBITDA that are used. And you can see how they vary and go and increase with the size of business. And I've tied the size of business to the annual turnover. So at the bottom end of the range, if you're sub 500,000, sub 400K, then the multiple of EBITDA will be around 2 to 4. Once you're over 5 million, up to 10 million, then the multiples are much more, are somewhat higher in that sort of 5 to 8 range. Now, we don't just look at what's in the accounts. We look at we do make some adjustments to make sure that any one-off costs that have been incurred in previous years are just added back to that bottom line. So we're looking at what's profits and income and cash generation a buyer can make from the company going forward. We also look at the directors' salaries and takings and what we call normalize that level. Quite often directors will take a minimal salary, but will be remunerated in the main in dividends, which are not part of the profit and loss in the accounts. What we do is add back that minimum salary, but we also deduct what it would think. Well, we think about what it would take to replace the business owner in the company. What do you need to replace yourself with? A general manager, or is it just a salesperson and an accounts person? It might be two or three people that sort of come in to replace what you do. But we think how you would be replaced, and therefore what would that cost in a notional sort of replacement salary, what you would pay in the marketplace. So that multiple of EBITDA will give you what we call a cash-free, debt-free valuation. We then look at the balance sheet, and if there is cash in the company which is surplus to the monthly working capital requirements, then that will be added to that value. If there are overdrafts and loans which are used and there's debt in the company, then that will be deducted from that cash-free, debt-free value. Buyers will look at valuation in many different ways. They'll look at what they as a company can make from from your business, and therefore when we go to market, we will always get a range of offers, and our job is to get a good choice and selection so that we can negotiate the best deal value and structure for you in that. So I've touched on sort of which businesses sell well and which don't sell quite so well, and some of the multiples used in valuations, which hopefully gives you an idea of where your business sits and whether you are sort of ready for that process. I will hand over now to Savi, who will talk a bit more about the legal aspects and the process of selling a company.
Hi, Harry, thank you very much. It was really quite explanatory. Yes, first of all, I would like to introduce Thackeray Williams. Thackeray Williams is a legal 500 law firm. We operate from office of London, West Wickham, Bromley, and the Sevenoaks. We are a full-service law firm. We offer advice in will, tax and administration, dispute resolution, family law, residential property, employment law, and real estate, and the corporate banking and finance, including commercial. Personally, I heads up the corporate, commercial, and banking department. We offer advice from an individual perspective, a company perspective, from an individual as a shareholder to a company as directors. And we specialize in merger, acquisition, and disposal, shareholder partnership agreement, joint venture, insolvency and restructuring, finance and growth funding, and any kind of commercial contract like a supplier agreement, like term and condition, privacy policy, and so on. So as we were discussing, as was presenting before, Harry, we are here today to talk about which business sell well and why, and of course understand also what are the procedure during the selling of a business. Now, first of all, we need to think about why people want to sell a business. What are the reasons of selling a business? As Henry was saying before, well, there are different driving energy, different force that drive someone to sell his business. One can be because there is a growth potential. Another one can be because maybe there are some new opportunity around, or maybe they want to capitalize what they've done in the last few decades or years. Or sometimes can be for personal reason. Maybe they lost interest, or maybe they have a strong passion for something else. Or maybe there is a strong competition, so it's much better to sell your business to someone else, or maybe I'm trying to merge with someone else. Now, first of all, of course, it's not about just deciding why and when I want to sell my business, but also, is your business attractive? That's a very important thing. So usually the kind of people that you are going to approach at the start, of being approached at the start, are going to be probably family, maybe some strategic buyers that for whatever reason want to integrate an acquisition from an horizontal or vertical prospect based on their company. Can be a private equity company that is interested or invest exactly in your sector, or maybe the management of the company. So you are at a certain stage where you want to retire, and so the management of the company affect what is called the management buyout. Now, whenever it's going to be the buyer, what they are looking usually is about return on investment, if the business is profitable, of course, and how is diversified the income on a customer base. That actually is a very, very important part, especially during a due diligence. As lawyers, we always check the contracts, we always check who are the clients of a company, because of course, if a company has an only client, one big company, that put the company at risk, because if they're going to lose that clients, basically the company doesn't have any income anymore. So usually it's good to have some kind of a diversification with different kind of clients, and client that doesn't have more than 10% probably in your income. Now, which business we usually want to buy? Of course, it's a business that is going very well, is not falling in profit, but actually is growing in profit. A business where we can reinvest, a business that maybe is following the market, have new product, new service, and they're approaching some niche market, maybe, or a market outside UK or different sector. Of course, the buyer usually not looking to buy some kind of business that is unable to keep with the competitors, or actually is going to have so much changes, is not able to adapt to the change in the market, especially during, example, the COVID. A lot of business were not able to adapt on the online new word, between parentheses, at online way to the business, and they were the one that suffered much more, and probably their profit and revenue were completely different. Now, thinking about when we decide to sell a business and we want to sell the business, there are basically two ways that usually you can sell a business. One is through a share sell, so there is a share purchase agreement, and one is through an asset sell, an asset purchase agreement. The difference between is that basically in a share purchase agreement, if there is a company, of course, because if there is a sole trader, then the only option is not an asset sale. But if there is a company, basically you are going to buy the share of the company. So when you buy the share of the company, basically there is a clean break from the seller and the buyer. The buyer is going to buy all the share of the company. There is a continuity of the business. Most of the agreement that are going to pass directly, they're not going to pass, are going to stay in the company that they're going to buy, unless a particular agreement has some kind of a change of control clause, then that they could give them the option to terminate the agreement. And the structure is quite common, and it's quite easy even from an employee perspective, because the employees are going to be still employed by the company, so there is no need to pass it through other kind of regulation like the 2P regulation that actually is going to affect an asset sale. Usually during an asset sale, the buyer purchases some specific assets. Sometimes can be also only the asset of the company, or sometimes even some liabilities of the company. Another things that is quite common with asset purchase agreement, it's really the fact from a perspective of the buyer that they can have a little bit more controls what they really are going to buy or not. It's a little bit more, it's a little bit different from a share purchase, because the fact that you are not passing completely the share from the seller to the buyer, but actually you are passing some assets, then there are some other kind of agreement that need to be put in place. Like example, you need some kind of a third party approval, maybe landlord consent to sign a lease, as we spoke before about the 2P, and so on, and other agreement where maybe probably you need to make an innovation of certain agreement. Now, whatever kind of option you're going to choose, or kind of option is going to be agreed between the parties, usually doing ahead of terms, then it's very important to understand exactly the terms that you are selling your business. And the most important things, of course, it's about the consideration. So the money that are going to pay you for your business. Of course, the best kind of a deal, or from a seller perspective, it's a cash business, a cash payment. So basically, you are going to have an exchange and completion, simultaneous or exchange and then a completion, and you're going to receive as a seller directly a cash consideration. So the purchase price was X amount of pounds, and they're going to receive at completion that kind of money. That is the one option that is very, very low risk. Sometimes still in a cash transaction, especially what we are seeing lately, especially after COVID, there is some kind of deferred payment. So basically, you can decide to pay some kind of money on completion, some kind of the rest of the consideration in deferred. That can be after 6 months, 1 year, or 2 years. Of course, if you're going to structure in that kind of the transaction that way, with a consideration, with a deferred consideration, then there is a higher risk, because maybe at one point the buyer is not going to be able to pay you back. So in that case, you are going to look for some other kind of security to put in place that are going to give you, or at least are going to mitigate the risk. Other way to pay a consideration can be like an earn-out provision, that usually is a portion of the purchase price will be paid on completion, and one portion in the future, based, as Henry was speaking, based on some financial factor that can be example an EBITDA. So if the EBITDA is going to reach some kind of level, then they're going to increase the payment. If the EBITDA doesn't reach some payment, then the consideration is going to be lower. Of course, it's a little bit more complex as kind of structure for what concerns the consideration, and can be a little bit risky, but maybe can be even more profitable for the seller if the earn-outs work in a way that can be favorable if you reach the terminal target of EBITDA. Other way, of course, are the loan notes that can be put in place. You need to still check if the loan notes are going to be secured or unsecured. Or some other times there can be an exchange between two businesses of share. So basically, that's not really a clean break, but there is the possibility that maybe the share are going to fail later on, or maybe still you can be part of another business and get more revenue in comparison to what you were getting before, if your business was struggling. Based on the payment provision, now we need to think about, yes, okay, now we know exactly which one is going to be the consideration, what kind of structure we want to have, but is my business really ready to be sold? Well, now, taking consideration that share purchase or an asset purchase that take a lot of time, what usually buyer will do is to go through a due diligence phase. So basically, when you're the lawyer gets started to draft their share purchase agreement, or asset purchase agreement. At the same time, the buyer is going to come with some kind of questionnaire. It's called a due diligence questionnaire. So he's going to ask anything about commercial, financial, and the legal of the company. What usually they want to do in their questionnaire? Well, they want to have any kind of banking and financial information of the company. They want to understand exactly how the insurance and which kind of insurance are put in place. With the GDPR, data protection information, how they're followed, any kind of details of the assets, tax information, staff information, IP information. And based on everything that they are going to see in the business, then probably they are going to shape their draft of their asset purchase agreement or share purchase agreement, asking some kind of warranty to the seller, or maybe sometime even indemnity if for whatever reason they found that something is a little bit too risky and some document are risky, or some kind of asset in the company are risky, and then they're going to look for some kind of indemnity. So providing all this information, of course, is going to take some time. That's why usually before you are approaching a buyer, before you are selling a business, you really try to to organize your house in the best way possible. So whenever you are going to have this kind of transaction, there is not going to be any kind of delay, because usually sometimes you start to have some delay. Maybe you are going to lose the opportunity of the buyer that's going to buy your business because for whatever reason is going to pull out. So it's very, very important when you start with the idea that I'm going to sell my business, you start really to have everything in place. Example, for whatever reason, you own a property and you are conducting your business from the property, but in reality, there is no any kind of a lease agreement in place. Or maybe there is some contractor that are working with you, but there is not an employment or a service agreement in place. and so on. So it's good to have everything in the right form, the right shape, and with all the terms and details or any kind of contract or agreement in place with a third party. A lot of time people ask us, how long is it going to take to sell a business? Well, I mean, there is not really a formula on how long it's going to take. Of course, if the transaction of the company are the bigger is the transaction, the more time can take. If the transaction is a little bit more sophisticated, it can take more time. And sometimes the transaction can be easier because maybe there are not so many relevant contracts in place. There is a simple structure in the company. The due diligence can be quite fast. But on an average, usually can take from a few months, 2-3 months, to even 6, 7, or 1 year time. So it's all about the preparation. As much as you're prepared at the start as a seller, if you have everything in place, then it's going to shrink that kind of amount of time between amending articles, amending shareholder agreement, if there is any shareholder agreement, or checking all the asset, the contract, etc., and until arrive at the end of the agreed form of asset purchase agreement on the share purchase agreement. Now, another important thing is, yes, we decide now that we want to sell the business. We decide everything is in place. We have the consideration. We have all the agreement agreed between the parties. Another thing that you need to understand is, well, what do you want to do after you sell your business? How important was your business during your life and after you are going to sell it? Are you ready to retire or start something new? Or actually, you would like still to work maybe in the same kind of business, maybe in the same kind of sector? That's very important to understand why, because usually from a buyer perspective, when they draft an asset or the share purchase agreement, they're going to put some kind of post-completion restriction. So that can be example that you cannot carry the business in competition with the company that you're selling, or you cannot poaching employee, you cannot poaching customer, or maybe you cannot conduct any business that is going to be in a certain geographic area. So it's really good to have a quick, clear understanding of what you are going to do after the business, so that actually you can be able to accept or not accept some kind of post-completion non-compete restriction. How we can help? So basically, as we're speaking, I mean, there are different people that are going to be involved during this quite complex process of selling your business. And it's very good to have, like, your financial advisor and accountant in place. It's good to speak with a broker as Henry, and then can, like, start to put together all the documents that you need and try basically to create the best form and shape for the company to be put in the market. It's like, creating a package for a gift or for something that you're going to sell. So the package should be very attractive, and that will become very attractive for a possible buyer. It's good to talk with a lawyer, of course, because you need to prepare for the business sale from a due diligence perspective, from a legal perspective, and then it's good also to understand all the transaction process, and especially the head of terms that you are going to agree or not, or that you would like to agree or not with a possible buyer. And another important figure actually is also the financial planner or manager, because usually, I mean, a lot of people, individual or company that they're dealing with a process like an M&A process, maybe it's the first time that they deal with that, because they were usually working with the company for 30 years. They own the company for 30 years. Then at one point they want to sell, and then they end up with a lot of cash. It's good to have a financial planner that is going to help you how to manage that cash, because it's completely different managing your personal asset by managing the assets of the company. This is from me. Thank you very much for your attention, and please let me know if you have any questions.
Thank you very much, Savi. That was absolutely fascinating, and to Henry as well. I'm going to ask if anyone has a question to ask, but I'm going to nip in first. And I'm really intrigued. How do buyers generally fund acquisitions? Is that towards you, Henry?
Yeah, okay, I'll take that first. Henry, obviously, if you're in the market to acquire a business, you need to have a certain amount of cash funds behind you to be able to do an acquisition. There are means of leveraging what the cash is put into that acquisition.
Henry, can
Yeah.
I just ask you to hold on one moment?
Yeah.
I think it's, who have we got? Someone's got, Francesco, we can hear noise behind you. You're not muted. Can you mute, please? Thanks.
Okay.
There we go.
Yeah.
Over to you.
Okay, so funding, firstly, yes, buyers will need to have a certain level of funds to be able to put into the deal. That can be leveraged through a range of financing, through funding on the assets of the company, whether it be sort of in a engineering company, sort of the equipment in the company, or on the possibly even the debtor book through invoice financing to leverage some of the deal. Then it will come down to how the deal is structured, and that some deals do include an element of what we call deferred payments post completion. In the States, it's called sort of vendor financing. So those are probably the three elements of that need to come together in the deal. But the key thing is that buyers need to be able to have some of their own funding to bring to the table.
Oops, sorry, I was on mute as well now. Thank you very much for that, Henry. Do I have any questions? Anyone got a question? No. Well, I'm going to ask one of Savvy now. This is a legal one. And what are the benefits of a disclosure letter?
Yes, so basically, as we described before, during the phase of an asset or share purchase agreement, so there is the phase of due diligence, then you're going to start to draft the share purchase and asset purchase agreement, and then there are going to be some kind of warranties in the asset and share purchase agreement. Now, the disclosure letter is an important document for not just the seller, but also for the buyer in the sale of a business. It provides the seller with the opportunity to make a disclosure against the warranty, which, if you're going to provide the disclosure, you give sufficient details about what you're going to disclose, protect the seller against any breach of warranty claims later on. And example, for whatever reason, there is a warranty that say that there were no any kind of proceeding against the company. So if in reality there is some kind of proceeding against the company, you don't disclose, that can be a breach of a warranty. But if you're going to disclose that, then a claim cannot be raised against you later on in relation to that breach of the warranty.
Thank you very much. That was absolutely fascinating. I think so. If we don't have any more questions, no, then I think we'll bring this to an end. And just to let you know that these slides will be going up on the website. And here we go. So we've got our forthcoming events here. And I'm delighted to say, just peering at them, that on Friday, the 5th of November, we've got a breakfast meeting with Gareth Bacon, and this is a real breakfast meeting at the Clarendon Hotel. So in particular, Peter, you've been on one of our round tables with Gareth. I hope you can make it. Okay, and then we're going to have the AGM, which is our legal bit. So thank you very much. Thank you very much for being here today. Thank you.
Thank you very much.
Okay, bye.
Thank you.
Thank you.
Bye.
Bye.
Bye.